Gold isn't breaking because the story broke. Gold is wobbling because a calendar-driven machine just got told to sell and the loudest people in the room are pretending it's panic. This is the kind of week where the tape looks guilty, the headlines sound confident, and the actual mechanism is boring, mechanical, and brutally price insensitive. And that's exactly why the setup is dangerous for both sides. Because when the selling is forced, it ends on a schedule, not on an emotion. And once you see that schedule, you can stop letting the crash narrative borrow your nerves. Stay with me, because we're going to map the pressure window, the hidden detail that makes hedge funds pushing shorts look bigger than it is, and the one level that tells you, this week, whether gold is being accepted lower or simply being shaken out before the next leg. Zoom out a week, and the move looks like a normal pullback. Zoom in a day, and it looks like someone opened a trap door under the market. Gold has been trading in the mid-4,000s per ounce. After a year, where it ripped so hard it put up one of those rare, this only happens once in a generation annual performance stats. That matters. Because when a market has a year like that, it doesn't just attract believers, it attracts rules, and rules don't care about your conviction. They care about weights, caps, and benchmark math. Now here's the part most viewers never get told. When you see sharp selling right at the start of January, especially concentrated into a tight window, there's a high probability you're not watching new information. You're watching new positioning. You're watching mandates being obeyed. You're watching desks trying to get ahead of desks. And you're watching liquidity thin out just enough that a big order doesn't feel like a big order until it does. But that's not the part that matters. The part that matters is why the selling shows up as a hedge fund short attack story, even when the original spark is passive. Because if you don't understand the plumbing, you'll blame the wrong actor and then you'll trade the wrong risk. Here is the calendar trigger the mainstream keeps skipping. Early January is not just New Year vibes. It's rebalance season for major commodity benchmarks. Think the big, widely tracked indices that institutional products, ETPs, and systematic funds use as their default commodity blueprint. Those indices update target weights based on rule sets, liquidity, production, diversification constraints, and this is the key, caps, so that no single commodity dominates the entire index. And after a historic year in precious metals, gold and silver can become too big in those benchmarks simply because price went vertical. Not because fundamentals got worse, not because demand collapsed, because math says you're overweight now. And when the math says trim, trackers trim, they don't trim because they're bearish. They trim because they have to be benchmark consistent. That forced trimming can show up as billions in futures selling, concentrated over a handful of sessions. And that's where the real pressure starts. Now let Wet talk about the number everyone is throwing around, this 8 billion hard count or 10 billion dumping number, because numbers are how narratives gain teeth. People hear 8 billion and picture a committee at a hedge fund slamming the sell button because they know something you don't tee. In reality, that number is best thought of as a notional estimate of how much exposure needs to be adjusted across tracking products during the rebalance window. Some estimates have gold alone in the mid-single-digit billions of futures, selling over roughly a 5-day window, with silver potentially even larger. Is that big? Yes. Is it end of the world? Not automatically. Because the futures market is designed to absorb size, until liquidity isn't there at the exact moment everyone needs to do the same thing. And in January, everyone needs to do the same thing. Here is a simple way to feel the scale without pretending we can see every order. If you were talking about several $1 billion of gold exposure being reduced, at prices in the mid-4,000s per ounce, you're in the neighborhood of roughly 1 million ounces of notional gold equivalent. In COMEX terms, that's on the order of tens of thousands of futures contracts. Not all at once, not necessarily all in one place, but concentrated enough that it becomes a flow event. And flow events don't trade like fundamentals. Flow events trade like weather. You don't argue with the storm. You track where it's headed and you watch for the moment it passes. But here was the hidden detail, the one that reframes the whole hedge funds pushing gold shorts story. The benchmark most people are talking about has explicit diversification rules. One of the core rules is effectively no single commodity can become too dominant. That includes a cap around the mid-teens percentage-wise for a single commodity in the index. If gold's weight swelled above that cap after a monster year, the rebalance has to drag it back down toward the cap. That one rule alone can create a mechanical sell program. It's not a view, it's a constraint. And when a constraint hits, the market gets this weird optical illusion. Price declines, open interest shifts, and suddenly people are screaming, hedge funds are piling into shorts. Sometimes they are, but the bigger point is this. Even if hedge funds are shorting, they might not be shorting because they think gold is headed to zero. They might be shorting because they're front-running forced selling. They're selling first, into thinner liquidity, hoping to buy back later as the forced seller finishes. That's not a conspiracy. That's a rational response to predictable flows. And that's why the narrative gets twisted. The headline becomes "Speculators attack gold," but the actual driver can be benchmarks rebalance, trackers must adjust, dealers hedge, opportunists lean into the flow. And if you understand that, you stop treating the move as a verdict on gold's long-term story. You treat it as a short-term stress test of market structure. Because if this is mainly a mechanical rebalance, the most important question isn't who is evil. The most important question is, how does price behave as the forced selling hits, and what happens right after the last forced order clears? Because that's when the math changes. Let me make the plumbing simple. An index doesn't own bars. It targets exposure. A tracker that follows that index typically expresses exposure through futures. When target weights change, the tracker has to sell some contracts and buy others to match the new recipe. That means real orders on real exchanges in specific contract months. Those orders don't negotiate, they execute. Now layer in the dealers and market makers who stand between flows and the rest of the market. Dealers hedge. They dynamically hedge. If big selling pressure shows up in futures, dealers may take the other side, but they don't want directional risk sitting on their balance sheet. So they hedge it, sometimes by selling other exposures, sometimes by adjusting options hedges, sometimes by moving along the curve. The key is that the act of executing the rebalance creates secondary hedging flows, which creates tertiary opportunistic flows. That's reflexivity. Price moves because flows move. Flows move because rules demand it. And then everyone pretends price moved because the story changed. But that's not the part that matters. The part that matters is what the curve and the spreads are saying while spot gets all the attention. Gold, structurally, often trades in contango, futures above spot, because there's a cost of carry, financing, storage, insurance. That upward slope is normal, but during a flow event, the shape can distort. When concentrated selling hits a particular contract, you can see spreads behave strangely. You can see the nearby contract get pressured relative to deferred months, or you can see roll dynamics get messy as everyone crowds the same lanes. And the market structure tells you whether the sell-off is real, in the sense of a broad repricing of gold S value, or technical in the sense of a localized pressure point from execution. This is why serious metals watchers don't just stare at a spot chart. They watch the term structure. They watch how liquidity behaves around the front month. They watch whether the selling is met with an immediate bid or whether it slices through support with no hesitation. Because if spreads normalize quickly after the rebalance window, it's a clue. The market was absorbing a forced event, not pricing a new world. Now, about the index rebalance triggers $8 dump framing. Let's clean up what that means. A dump implies voluntary disgust. A rebalance implies compliance. And compliance is scheduled. Most major rebalances happen over a defined sequence of business days. In this case, the pressure window is early to mid-January, with a lot of estimates focusing on a 5-business-day execution period inside roughly the January 8th to January 15th range. That matters because we're not dealing with a random storm. We're dealing with a storm that has a forecast and a closing time, and that's where the opportunity and the risk come from. Because the market is forward-looking. If everyone knows selling is coming, the sell can start before the official window. Traders lean into it early. Then, during the window, the forced selling hits, often at predictable times, while opportunists try to ride the wave. And then, after the window, something nasty happens to late shorts. The forced seller is gone, but the shorts are still there. Now, the market doesn't need fresh buying to rise. It just needs an absence of forced selling. It just needs shorts to cover. And when liquidity is thin, covering can look like a vertical candle. That is why the most dangerous thing you can do is wait until the move is obvious and then join the crowd. Because if you short after the forced selling is mostly done, you're not trading the same setup. You're trading the echo. But here's another twist. Even if the flow is mechanical, it can still trigger genuine risk reduction elsewhere. In a market that has been strong, a sudden downdraft can cause margin pressure. It can force some leveraged players to lighten up. It can cause cross-asset de-risking. Gold is sold to meet margin calls or because volatility in another asset spiked. That's when a mechanical event can briefly become a broader liquidation. Not because the thesis died, but because the plumbing got stressed. And that's where many retail investors get emotionally manipulated. They see a sharp drop and assume it's new information. They interpret it as smart money knows something. They sell at the exact moment the flow is doing the most damage. And then they watch the market stabilize when the forced flow ends. That's why your edge is not prediction. Your edge is recognizing what kind of sell-off you're in. Now let's build the proof stack, because I'm not asking you to believe a story. I'm asking you to watch for signals that are consistent with mechanical pressure. Proof point 1, the calendar alignment. Big moves hitting right into early January with a very specific industry narrative about commodity index reweighting. This is classic flow seasonality. Proof point 2, benchmark weight changes. Gold's weight in a major commodity benchmark is expected to drop meaningfully from around the low 20% down toward the mid-teens because it got too large. When you hear that, understand it like this. Gold didn't become worse. Gold became too successful. The index had to cut it back. Proof point 3, price action across metals. When you see gold, silver, and sometimes copper all getting hit in the same breath, that often smells like broad commodity flow repositioning, rather than one isolated fundamental shock. Proof point 4, the difference between futures pressure and long-only behavior. If this were a true collapse in demand, you'd expect the easiest exit door, ETPs and ETFs, to bleed relentlessly as holders bail. But in many mechanical events, ETF behavior is more stable than futures behavior. The pain shows up first in the paper markets. Proof point 5, the macro backdrop. Gold can drop even in a gold-friendly regime if the dollar catches a bid or if real rate expectations reprice. That's not a contradiction, that's mechanics. Short-term price is a tug of war between growth expectations, rate expectations, currency moves, and positioning. Gold is not a one-factor asset. Proof point 6, physical demand and official sector behavior. Central banks have been a notable presence in the gold market in recent years. They don't trade like day traders. They accumulate based on reserve strategy, currency risk management, and geopolitical diversification. That bid doesn't erase volatility, but it does matter when you try to judge whether a pullback is end of story or pause inside story. Now, I'm going to say something that will annoy both camps, the permabulls and the permabears. The permabulls want to believe every dip is manipulation. The permabears want to believe every spike was a bubble. The reality is less dramatic and more useful. Markets are incentive machines. When a predictable forced seller is visible on the horizon, incentives align for front running. If you're a fast trader and you know a benchmark needs to reduce gold exposure over a defined window, you have an incentive to sell before the window and cover into the window. That behavior itself can create the appearance of hedge funds pushing shorts. And sometimes, yes, it can look aggressive, but the motive is not necessarily crash gold. The motive is harvest the flow. Oh God. And that's why the crash narrative is often exposed right after the rebalance finishes, because the selling pressure evaporates and the same traders who leaned short start buying back. That's where the tape can flip without any headline changing. And that's when late shorts get punished. Now let's talk about what paper versus physical tension actually means in plain language, without turning this into a conspiracy sermon. Futures are where price discovery happens quickly because they're liquid, levered, and standardized. Physical is where reality lives because it has lead times, logistics, storage, refining constraints, and location-specific scarcity. When futures get hit by a flow event, physical doesn't instantly reprice in the same way. Physical premiums, availability, and delivery behavior can lag. Sometimes you even see the weird phenomenon where the paper price is down, but on the ground buyers are still paying up for certain forms, certain locations, certain delivery terms. That divergence doesn't mean the market is rigged. It means different layers of the market are responding to different constraints. And during an index rebalance, it's the paper layer that gets shoved around by the rulebook. So if you're trying to understand whether this is a true collapse, you ask, are we seeing a genuine deterioration in physical appetite and official sector interest? Or are we seeing a paper market being forced to compress exposure? Because those are different beasts. One is structural, one is temporal. And temporal beasts end, but don't get lazy, temporal beasts can still bite. Here's where retail gets punished. They assume mechanical means safe. It doesn't. Mechanical can be violent. A forced seller can push price below a level that triggers stops, which triggers more selling, which triggers margin calls, which triggers cross-asset liquidation. That's the margin spiral. It's not personal, it's leverage math. And if you're not respecting that possibility, you will oversize and you will make emotional decisions. So let's be disciplined. We're going to hold two scenarios in our head at the same time, because serious market participants do not marry one storyline. Scenario 1 is the controlled pullback and retest. In this scenario, gold sells off into the rebalance window, probes lower levels, then stabilizes as liquidity returns and the forced selling gets absorbed. You typically see basing action, failed breakdown attempts, and then a move back above a key pivot level that tells you buyers are stepping in. It doesn't have to rip immediately, it just has to stop behaving like a falling knife. Scenario 2 is the continuation squeeze, but not the squeeze you think. This scenario starts with a deeper flush. Price breaks a key support and triggers a cascade. It looks like the bears were right. And then the squeeze happens upward, not because the world got better overnight, but because the market got too short right as the forced seller finished. The squeeze becomes a gap risk event. Thin liquidity, shorts scrambling, dealers adjusting, and suddenly the market jumps levels without giving you a clean entry. Both scenarios are plausible. The job is not to guess which one is destined. The job is to define what would confirm each, and what would invalidate each, so you don't get emotionally hijacked. Now let's anchor this to levels, because narratives are seductive and levels are honest. In early January, gold has been swinging through a broad band, roughly the low to mid 4,300s on the downside and the mid 4,500s on the upside, depending on which print you're looking at and which session you're tracking. In that kind of environment, the most important levels are not $1 precise. They're zones where the market previously found buyers or sellers and where liquidity clusters. Here's how to approach it without pretending you're a wizard. Identify the most recent swing low that formed before the rebalance chatter intensified. That is your first, is the market accepting lower? Test. If gold breaks that zone and then cannot reclaim it on a retest, that's evidence the market is willing to transact at lower prices, at least for now. If gold breaks it intraday, scares everyone, and then reclaims it quickly, especially into the close, that's often a sign of stop hunting inside a flow event. Next, identify the mid-zone pivot where price chopped in the middle of the range, where it bounced and failed multiple times. That pivot becomes your tape-turned line. Above it, sellers lose control. Below it, rallies can be sold. And then identify the recent highs, because if gold can reclaim the upper zone after the rebalance window ends, that is a statement. The market absorbed forced selling and still wants higher prices, because if that one level breaks, the math changes. Now, let's address the hedge funds pushing gold shorts claim directly, because it's not wrong to think speculators are involved. It's just incomplete. Hedge funds often trade around flows. Some will lean short because it's the cleanest way to express selling pressure is coming. Some will buy puts, some will sell calls, some will do relative value, short gold, long, something else. But the public loves a villain, so it becomes their suppressing price. And the more accurate framing is, funds are exploiting a predictable supply of paper selling. They're trying to get paid for being early, and that behavior can intensify the move. But it's not the origin. The origin is the rulebook forcing passive trackers to rebalance. And the hidden detail is that the rulebook has caps, explicit ones, that can create a cliff in demand for a commodity that got too large. In other words, the market can be temporarily over-owned by benchmarks, and the rebalance is the market's way of delevering that ownership. That's why the same year that creates bullish headlines also creates bearish flows in January. It's the hangover of success. Now, what about the macro overlay, the part everyone uses to justify whatever they already believe? Here's the sober version. Gold is sensitive to real rates, the dollar, risk sentiment, and geopolitical stress. If the dollar strengthens, it can pressure gold in dollar terms. If markets start pricing fewer rate cuts or a more cautious central bank path, real yields can move, and that can pressure gold's opportunity cost. None of this means gold is over. It means gold is trading like an asset in a complex system. And in early January, that complexity gets amplified by positioning. That's why you can have a bullish long-term thesis and still see brutal short-term pullbacks, because the short-term market is not voting on the long-term thesis, it's clearing positioning. But that's not the part that matters. The part that matters is timing. Timing is what separates getting shaken out from getting positioned. The rebalance window gives you a timing map. Pressure tends to cluster into that window. The days right before and right after can be deceptive because traders try to anticipate and then unwind. That means you should expect whipsaws. You should expect fake breaks. You should expect the market to punish anyone who overcommits to a single directional bet without a plan. And yes, this is where volatility becomes a weapon. Volatility is the market's way of extracting emotional payments. It makes you feel stupid when you sell and it bounces. It makes you feel invincible when you buy and it drops. It makes you chase when you should wait and freeze when you should act. The simplest psychology shield is this: separate trend signal from noise. Trend signal is what happens after the flow event ends and the market either reclaims key pivots or fails them. Noise is the intraday chaos while forced orders are still hitting. If you can hold that distinction, you stop letting the market rent space in your head. Now, I want to make this ultra practical. What do you watch in the next week or two? First, watch the calendar. If we're in the heart of the rebalance execution window, assume there's mechanical pressure until proven otherwise. Second, watch whether the sell-offs are being bought faster over time. Early in a forced event, sell-offs can cascade because liquidity is surprised. Later, the market adapts, bids step in, and dips start getting absorbed. Third, watch the curve and spreads for normalization. You don't need to be a quant. You just need to notice whether the market stops feeling stressed. Or fourth, watch the dollar. If the dollar is ripping higher at the same time, it can amplify downside. If the dollar cools while gold stabilizes, that's fuel for a rebound. Fifth, watch positioning signals, at least conceptually. If speculative positioning has already come down, the market can have less air pocket risk. If everyone is still leaning the same way, risk stays high. Sixth, watch for the moment the crash narrative gets loudest. That's often near the end of forced selling because the move finally looks convincing to the most people. That's when late shorts get trapped. But don't take that as a guarantee. Take it as a warning. The most obvious narrative is often the most crowded trade. Now, let's talk about invalidation, because credibility lives here. What would make the mechanical dump thesis fail? If gold breaks below key support zones and then cannot reclaim them even after the rebalance window is over, that's a problem. That would suggest the market isn't just clearing forced selling, it's repricing value. If you see sustained outflows from long-only holders and a persistent deterioration in physical demand signals, that's also a problem. If macro conditions shift hard against gold, stronger dollar, rising real yields, easing geopolitical premium, those can weigh longer than a single week. And if broader risk markets enter a true deleveraging phase, gold can get sold for liquidity, even if the long-term story remains intact. Those are real risks. So the disciplined stance is not gold can't go down. The disciplined stance is gold can go down violently, even if the thesis is correct. And the job is to size and plan so you can survive the noise. That's what professionals do. They don't need to be right on every tick. They need to stay in the game. Now, the payoff, why the crash narrative gets exposed. If gold's weakness is primarily driven by forced index-related futures selling, then the conclusion of the execution window changes the supply-demand balance in the paper market immediately. The forced seller steps away. The opportunistic shorts who front-ran the flow start to cover. Dealers who hedge the selling pressure adjust as the flow dissipates. And the market can do that infuriating thing. It rises on nothing. It rises because the selling stopped. And when a market has been strong in the bigger picture, the absence of forced selling can be enough to spark a sharp rebound. This is why when you hear hedge funds pushing gold shorts, you should immediately ask, are they pushing because they believe the macro story changed? Or are they pushing because a forced seller is visible and they want to rent the move? Because those are two different trade horizons. One is a thesis, the other is a tactic. And if you confuse the two, you'll either panic sell a long-term position during a tactical shakeout, or you'll stubbornly hold a tactical short after the forced seller is gone. Both mistakes feel different emotionally, but they come from the same blind spot, not respecting market structure. Here's the cleanest way to think about it. This week is a test of price discovery under mechanical stress. If gold holds its structural integrity, meaning it finds buyers in logical zones, it stops cascading, and it can reclaim key pivots, then the crash narrative is mostly theater. If gold fails those tests and keeps leaking lower even after the flow window should be done, then we take the hint. The market is doing more than rebalancing. We don't argue, we adjust. That's the mindset. Now, for the metals and commodities, crowd specifically, the people who care about physical reality, there is an extra layer. Gold is not just a trade. It's a reserve asset. It sits at the intersection of trust, currency stress, and institutional behavior. That means it can absorb things that other commodities can't, but it also means it can be used as a liquidity source during stress. So you must hold both truths. Gold can be a long-term store of value theme and still be a short-term volatility machine. That's why it attracts both believers and scalpers. And that's why January flow events matter. They reveal how much of the market was owned for the right reasons and how much was owned because it was going up. If the market shrugs off forced selling and stabilizes, that's evidence the base is deeper. If it collapses and can't get up, that's evidence the rally was more fragile. Either way, you get information. That's the point. So here's your near-term roadmap in plain language. If we're still in the heart of the rebalance window, expect volatility, expect head fakes, expect the market to try to emotionally bully you. Your job is to watch whether the downside accelerates or gets absorbed. Watch for a clean reclaim of the pivot zone that defined the recent chop. If gold can reclaim it and hold, that's confirmation the worst of the forced selling is being digested. Watch whether rallies start to hold higher lows. If you get a deeper flush, don't assume it's over. Wait for evidence. Failed breakdowns, strong closes, stabilization in the curve. If instead gold slices through support and retests it from below and fails, respect that. That's the market telling you it's accepting lower levels. In scenario 1, the controlled retest, the market will frustrate both sides and then slowly regain footing. In scenario 2, the continuation squeeze, you can get a violent flush followed by a violent snapback. Both can happen within days, and that's why sizing, time horizon, and discipline matter more than being right. And yes, this is also where the institutions win psychological games. They know retail sees a big red candle and assumes the top is in. They know retail sees a big green candle and assumes, I missed it. Now, they know that whipsaw is the fastest way to transfer conviction from the public to the professionals. Your shield is process. Your shield is watching the schedule, watching the levels, and refusing to treat intraday chaos as a long-term verdict. One more detail, because it knocks the kind of thing that flips the setup. When goldist's benchmark weight is reduced from an elevated level back toward a cap, the selling is inherently finite. It is not an endless supply of sellers. It is a measured adjustment. That means the biggest risk for bears is time. They can be right on the direction during the window, and then wrong immediately after. That's why you often see the weird pattern. Selling into the window feels unstoppable, then suddenly it isn't. The market doesn't need a positive catalyst. It just needs the negative flow to stop. And when that happens, the same people who were celebrating the drop start looking for cover. So if you're watching gold this week, the question isn't, is gold dead? The question is, where does forced selling end, and what does the market do when it ends? Because that's where the real signal lives. Now I'll give you a clean, non-beggy call to action. Because if you're still listening, you're not here for vibes. You're here for mechanisms. Don't join the crowd that trades headlines. Be part of the group that trades structure. Over the next sessions, keep a simple checklist. Know the rebalance window, track whether sell-offs are getting absorbed faster, watch the pivot reclaim, watch the dollar and real rate expectations, watch for the post-window tape to either stabilize or break down. If you do that, you won't need to guess, the market will tell you. And if you want to stay sharp with a community that cares about the plumbing, futures, flows, physical constraints, and the game's volatility plays, stick close, because the next move won't be decided by the loudest narrative. It'll be decided by the quiet mechanics that just finished doing their job.